understanding bond characteristics. Let's talk about bonds. Okay, so let's think we are a company and we need some financing. Maybe we're building a new factory, we're coming out with a new clothing line, something where we need some money, right? So we can invest or get some investors in a few different ways. And one of those ways is to issue bonds. Okay, so this is just a way for companies that need some financing help. They can issue bonds to raise money. Now, issuing bonds is a form of debt and a legal agreement between the bond issuer, which would be the company, and the bond holder, which is the person who purchases the bond. All right, so the issuer sells the bond to the holder. Now, the holder then pays the money for the bond, which then allows the company to use that money for whatever they need. The issuer gets that financial help, and the bond holder earns interest. So it's kind of like putting money in a savings account for the bond holder. You're giving money to the issuer, and then later they will pay you back with interest. So a reason that a company might issue bond rather than something else, the company can, the tax deductible, the company can use the interest that they pay on the bonds as a tax deduction. So it will lower their taxable income, they'll pay less taxes. Bonds do not relinquish any control in the company. Whereas if they issue stocks and people buy stock is an actual of the company, so they lose some control. And bonds generally have lower interest rates than a bank loan. So the interest the bond issuer pays to the holder is lower than the issuer would pay to the bank if they have a traditional bank loan. Now, bonds are rated by credit agencies. Now, these ratings basically are all about the risk of the bond. So the rating can be anywhere from a AAA to a C. And if you have a AAA rated bond, that is the highest quality. So that means it's low risk. You're very likely to get your money back. A C is the highest risk to bondholders. Just think about it. You are buying this bond, giving money to a company so they can do something with your money. If that company flops and goes under, you lose your money, right? So you want to, highest risk, that could be risky, but if you get the AAA, the highest quality, low risk, you're more likely, based off all kinds of things, I guess, of getting your money back later. Now, the math part of this, we can calculate the tax savings based off that tax deductible interest, right? Because this is the advantage of bonds over other investments for the company, is that they can deduct the interest from paying on those bonds. And we find that by taking the tax rate of the company times the total interest payment, and that is how much they can deduct in their taxes. So let's do one of these. A local company issued $450,000 in bonds and pays $11,250 annually in interest to the bond holders. The tax rate for the company is 22.5%. What are the tax savings related to interest for this company? Okay, so the tax rate is 22.5%. The annual interest rate, or annual interest, is $11,250. So if I multiply those together, right, tax rate times total interest payment. So I change my 22.5% to a decimal 0.225, and I multiply by the total interest paid, $11,250, and that gives me a tax savings of $2,531.25 annually. So the company will benefit from this as a result from issuing bonds with tax deductible interest payment. So when this company goes to do its taxes the next year, this is a deduction they can use. Thanks for talking about bond characteristics.